The ECB has signalled that tackling inflation trumps all else. It has pressed ahead with 0.5 percentage point increase in Eurozone interest rates. There had been calls for the central bank to tone down its approach in light of concerns surrounding the global banking sector. However, ECB President Christine Lagarde says it is still determined to fight inflation and indicated that further rates rises would be necessary. She added that policymakers were monitoring market tensions. Well, let's speak to Andreas Pfingsten, who is a professor at Finance Centre Münster at the University of Münster. Thanks a lot for joining us on the programme. So what is the thinking behind the ECB pressing forward with this 50 points rates hike?
Well, actually, I was not surprised learning about it yesterday because the ECB more or less had announced this additional step. And I mean, credibility is really important for a central bank. And so sticking to this original plan was no surprise for me.
Yeah, what would have been a surprise perhaps would have been if they raised it by just 25 points or not raised it at all, which is what some analysts had wanted. But how would that have affected the ECB's wider strategy for tackling inflation?
I mean, we are nowhere near their target rate at 2% or so. And so it would have been hard to believe that after not increasing the rate by 50 basis points right now, they would return to the initial path, because interest rate hikes mean that you will slow down the economy, which is a problem in some sense, but slowing down the economy just to save some banks would have been difficult to communicate to the public.
But there are other sectors of society that would obviously like to see interest rates not rising by too much more because of the impact that, yes, as you say, it does have on economies. So is the ECB walking this line correctly between trying to get inflation down but also not having a big impact on the Eurozone's economy?
I think they maneuvered themselves into this situation. I mean, the we are seeing now are pretty tough looking at the economic situation in general, but after having been very loose in their liquidity provision, that's something, as I said, they've maneuvered themselves into that.
The Federal Reserve in the US has signalled it may tone down its approach to raising interest rates. Should we expect to see that from the ECB next time round, perhaps?
In one of the next rounds, I would say they will slow down, yes.
And is that going to take its toll on the overall approach? I mean, because you've already said that, you know, that would be a reaction to what the banks want. Isn't that just doing exactly the same thing, just at a later point?
Well, actually, you have to clearly distinguish between banks in the US and Europe. We do have a stricter banking regulation in Europe, or, I mean, it's sometimes difficult to tell whether it's a matter of regulation or supervision. So I think the banks in the EU area are better prepared and have more capital to withstand the effects of interest rate increases. So here in Europe, the pressure doesn't seem that high to slow down the interest rate increases from the banking perspective. Because in general, you should be aware that typically banks earn more money when interest rates are higher, because then on the deposit side, they can earn larger spreads.
I see. OK, Andreas Pfingsten from Finance Centre Münster. Thanks a lot for joining us on DW Business.
My pleasure.
Well, the nearly €51 billion lifeline Credit Suisse has received from the Swiss Central Bank buys the company some time. Investors have been calmed and the bank's stock has regained some of its value. But the deeper problems at Credit Suisse have not gone away, and the Swiss authorities are now thinking about its future.
Zurich is Credit Suisse's home base, and on the streets it's business as usual. People here appear to be largely unaffected by the recent turmoil surrounding one of Switzerland's biggest banks. Most people here welcome the central bank's move to lend more than $50 billion to the ailing bank.
I think that's the right step at the moment. And now they have to show that they can do it well and are careful so that people have real confidence again.
It's a systematically important bank and it has to catch itself, and I think it will catch itself.
Many believe Credit Suisse may not have to use all the liquidity provided by the central bank, but they're glad the move calmed investors as the stock bounced back. After all, banks are more important to the Swiss economy than chocolate and watches.
It's not likely that they're going to use it, but the fact that it gives the market confidence that, the government will not let the bank to fail, or they will intervene if the investors panic persists. So I think this is a very effective way to kind of calm down the market.
Moving forward, the Swiss government is considering different scenarios, including a forced merger. The idea is that UBS would take over the ailing Credit Suisse. But people familiar with the matter say UBS prefers to focus on its own wealth-centric standalone strategy and is reluctant to take on risks related to Credit Suisse.